The consumption stocks in general, like if we saw the Q1 earnings of them, they posted a robust improvement in profitability now, but the rise in profitability was mainly because of the declining input costs, as crude was on a decline. But now that inflation is once again surging, the crude oil prices are once again surging, it will hit the profitability of consumption companies because we didn't see any growth in volumes. So can we expect some correction going forward?
Yes, corrections in any sector which is a relative outperformer. Right? What is relative outperformer? In a rising market, it rises more in percentage terms as compared to the broader market, and in a falling market, it falls less, or it is steady, or maybe even not fall, but it will fall less. And as far as your concerns about crude are concerned, I have a kind of a contrarian opinion. There is no rally, in my opinion. Forget about a super cycle. There is no rally. There is no bull market in crude. This is unbacked currency which has been printed post COVID, which is triggering an inflation. And do you see buyers banging on the doors of crude exporters, or are you seeing exporters creating a man made shortage by cutting output? So when you see the Saudis cutting more than 1 million barrels a day, the Russians following up with approximately 800 barrels a day in output cut, you basically see that prices are rising because artificial scarcity is being created. As a matter of fact, look at what happened to natural gas. Natural gas spiked up last week on Wednesday rather, when news came that three companies in Australia which supply LNG, liquefied natural gas, are on the verge of a very crippling labor strike. Now, these companies supply 10% of natural gas to the world. When this news came on Wednesday, natural gas shot up. We sent out a report saying this is nothing but fear mongering. Yes, there would be strikes, but do remember, Australian companies do not supply natural gas to Europe where the price has jumped. They only supply to Asia, and spot delivery prices in Asia have not jumped. Very promptly on Thursday, you've seen a collapse in prices. Even today, you're seeing a 6% decline in natural gas on my trading terminal. So I don't think your concerns about rising crude or natural gas prices going forward will hit margins of FMCG or consumption companies. As a matter of fact, I have a very bearish view for crude and natural gas going forward in the year 2024, particularly after the vernal equinox sets in on 19th March. I'm not talking of astrology. I'm talking of change in seasons. That is when the warm weather kicks in and heating demand for these fuels falls.
Okay, since we're talking about crude, I wanted to ask you, Vijay, at this juncture, how do you see the crude journey from here on? You pointed out that there's been an artificial shortage created. OPEC has cut down its production twice now. Do you see crude prices going up? What is the trajectory of crude that you are foreseeing at this point?
Let us first understand that crude is not just a commodity. It is a very complex market. To that extent, even natural gas. There is geopolitics, there is demand supply equation, there is politics, there is terrorism, and there is demand supply push. And therefore, this is a very complex market. Vis-a-vis, what you see is what you get, does not exist in energy markets at all. You see, OPEC as a cartel, as an organization of exporting countries, sets quotas for all its members as to how much they can produce and export. And these quotas are actually violated more often than they are adhered to. So, what is being said and what is being done are two different things. They are like chalk and cheese. So, will crude prices go up? I would go to the extent of saying yes, the Saudis and the Russians, along with OPEC plus, OPEC and non-OPEC members who come together, will attempt to push prices of crude higher. But will crude prices sustain higher? In my humble opinion, no. They will go up only to meet resistance. Do remember, anything above 80 to $85 a barrel in WTI crude terms, Western Texas Intermediate Grade crude terms, will suddenly see demand destruction to the detriment of fossil fuels and to the benefit of shale oil and shale gas. So if the OPEC, and they're very aware, they're very clued on, they're very smart people, they know that if they take crude oil prices beyond 90, they are axing their own feet. So I don't think it will happen.
Sir, but US crude stock has also dropped by about 6.2 million barrels last week. Now, this was much ahead of the expectations, which had pegged it at about a 2.3 million drop. So clearly, we are seeing that the supply, that the stockpile of crude is also declining, significantly and much beyond the expectation of the market. So, is it not going to give that a trigger for the crude prices to increase further, at least in the very short term?
You see, prices move based on developments, news events, and guidance or announcements by the administration. Now, drawdown of reserves is not something new. The US has gone on this path deliberately, well known in the public domain since 2022. The US has tried to get OPEC to raise its output and has failed, and therefore drawn upon its strategic and non-strategic petroleum reserves, which is unknown. And any event that is known to the market does not cause a shock. It is the unknown unknown, as it is known in behavioral finance. Unknown unknown is something you never imagined, you did not know, but it occurs. Now, the fall in inventory is not an unknown unknown, which is why on my screen I'm seeing more than 150 rupees decline in crude on the MCX as I'm talking to you during this interview. Market is very comfortable with the fact that these drawdowns will occur. There is an election in the US in November 2024. Ahead of the election, every time this election occurs, the administration dips into its kitty of crude, supplies it at the petrol pump so they can ease the inflation and fuel price for an average citizen. So this is a once in a 4-year phenomena. Market knows about it, so there's no panic.
So talking about unknowns is like China's economic activity. One week we read that activity is picking up, and then the other week the macroeconomic data shows that the economic activity is actually declining. So China being a very big importer of crude, how do you see that dynamic playing out in the prices?
Well, do you actually know that China has struck crude oil and natural gas both, and has huge reserves of methane hydrates, which is 164 times bigger than natural gas reserves per square meter. China is also building up its own reserves, which are supposed to be, of course, significantly larger than the US. And China has been stockpiling crude. And secondly, the economic data that you are so talking about China is something I would take with not just a fistful of salt, but with a gunny sack full of salt. Data from China tends to be colored and checkered at best. Look at the Bloomberg or the Reuters reports on the tele-rate tickers today. The Chinese government is actually telling funds not to sell shares on the Chinese stock exchanges because the stock market is going down. The Chinese have stopped disclosing data of unemployment in the youth. The Chinese have stopped giving NPAs or non-performing assets bank-wise, individual bank-wise since the last couple of years. They refuse to divulge the shadow inventory of commodities that are lying in their godowns unsold. So are you looking at a very robust economy from my point of view as a trader? No, I don't think so. I don't think China is going to be a major domo consumer of commodities. It's already coming down where its exports are concerned. Look at the price of iron ore, which has collapsed in China. Look at the price of copper, which is the bellwether and barometer of industrial activity in the world. Copper prices are sharply lower. And these are all telling me that we are down for slower times where China is concerned.
All right, and sticking on to crude, I think the conversation would remain incomplete if we are not to bring in Russia into the conversation. Now, crude oil import from Russia rose nearly threefold in the first quarter of this fiscal year compared to the last quarter or the first quarter of last fiscal year. How are you looking the relationship between India and Russia going forward, mainly on the back of the fact that the interest rates in Russia today are at an all-time high? How is that going to impact crude and of course the prices of crude oil that will be delivered to India?
First of all, it needs to be understood that whether it is the Middle Eastern countries or it is Russia, when they are depending on exports of fossil fuels to raise revenues, there is only so much bluffing that you can do by triggering output cuts and raising prices. When you resort to output cuts, the inventory that you have in your oil wells, the valuation of that inventory goes up, sure. But how do you raise cash? You will raise cash not on your inventory valuations, but by selling. And when you start to sell, the price comes down. So in commodity traders, us commodity traders, we have an old saying, the cure for high commodity prices is high commodity prices. So when prices are going up, Russia has no other recourse but to sell more crude and raise cash. Remember, they are at war with Ukraine and they need to fund this war. And we all know from secondary school economics that we were taught since childhood that wars are very expensive affairs. They are inflationary. They trigger a lot of economic distress and pressures on the economy. And therefore, no matter how much the Russians bluff, or for that matter, the Middle East Gulf countries blush that we will cut output, where do you raise cash? You have to sell.
Okay.
And there are media reports about obscure trading companies that have sprung up in the last 12 months or so, which are buying crude from Russia and supplying in European and Asian countries to skirt sanctions. This will continue.
All right. So Vijay, to cut it short, what is the impact we are going to see for India? Are we seeing crude inflation going up? Are we looking at spending more money to get the same amount of crude as opposed to what we were spending about a year ago? What sort of impact are we looking at on our current account deficit at this point?
I don't think our crude import bill is likely to go up unless a black swan event comes, an outlier event comes. Say China attacks Taiwan or something else like that happens. You must remember that there is one thing about rack rates in crude prices, and the other thing, backdoor discounts that the Saudis, the Russians, the Iraqis, the Iranians give. So you could say that I'm not going to sell below 80, but you're saying that in front of the media. But you could whisper to your buyers, hey, when you come to me, I will sell it to you at 5% less. Look at how the Saudis have assured Asian and the North American markets that we are going to supply all the crude that you need in spite of our output cuts, and all the discounts will continue. So I don't think our crude bill is going to go up. No worries there at all.
All right. So that is, of course, an interesting, important point of view. Crude bill not likely to go up. This may not have any impact, of course, on India, even as Russia continues to increase interest rates. Remember, the trade between India and Russia, in fact, Krishna Kumar, who joins us here in the studio, is at an all-time high, and there has been a threefold increase in import of crude oil from Russia in the first quarter of this financial year. Vijay, thanks very much for taking time out this afternoon.